Good afternoon, guys. Good afternoon. I'm just going to give you a few seconds, a minute or so to enter the room. And let's get this underway. Fantastic to see some regular names here. Excellent. All right, so good afternoon, traders. Welcome to this special webinar on risk management in trading and investing. Look, while the title of this presentation may not generate fireworks and send us all running to learn more, it really should. I say this simply because no matter how wonderful your trading system is, no matter the win percentage, no matter the profit factor, risk management will keep you in business and help mitigate a potential margin call, which is not a place we want to be. Just bear with me, guys. Just bear with. All right. So I strongly encourage all attending today to continue their education in managing risk after this session, as to be frank, as traders or investors, we are risk managers first and foremost. Now, risk and return is in investing and trading is at the forefront of, it's at the forefront of required knowledge. Every trader experiences losing streaks, no matter who you are, and we just have to find ways of mitigating the negative influences as a result of these losing streaks. So importantly, we all have different preferences when it comes to risk. Some of us are more risk averse, and some of us have more of an appetite for risk. For those of you who are unaware, who's behind the mic here, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. So look, as usual, very quickly, guys, there should be no issue with the sound, and there should be no issue with the welcome slide on screen right now. If there is, do let me know in the chat box, and the support team will try and help you out. Look, it's fine to fire across any questions you have during the presentation, but if it's something that you may require a more in-depth, response, please consider waiting until the end, as we may clear up queries as we proceed. So as usual, guys, a quick disclaimer. So trade responsibly. Derivative products are highly leveraged, carry a high level of risk, and are not suitable for all investors. This is not investment advice, guys. This is purely an educational presentation. All right, content. So up first on the stage, of course, we're going to define what risk management means. Then we're going to switch over to things that the different risk management techniques that are available for us as retail traders. Also, we'll have a Q&A session. Look, for any questions I miss, it really would be good if we could wait till the end. But look, for any questions that I do miss, or those that require a more detailed answer, you feel free to email me and the research team at marketanalyst@fpmarkets.com. You'll see a link in the chat box, and we'll get back to you as soon as we possibly can. Also, do feel free to send across any topics you wish us to cover in future webinars. All right, getting straight into it. So what is risk management? What does it mean? Well, for me, risk management is really mitigating the preventable negative price fluctuations in your trading and investing. Now, risk is a term that can give rise to a few different meanings, depending on who is asked. So an everyday investor may state that risk is simply the amount of money he or she could lose. But if you ask a finance professional, they will likely state that risk is defined as the standard deviation of periodic returns. Now, the professional does not classify risk in terms of a dollar amount, but more as volatility or dispersion from a central tendency. So think of a central tendency as your mean price, your average return price. So we're all aware, or we should be, that all investments carry risk. But there are two fields of risk that are important to understand. One type of risk can essentially be mitigated through diversification, and another, unfortunately, is pretty much unavoidable. So the point is, not all risks are equal. So that brings me nicely onto the next slide: systematic risk and unsystematic risk. This is a little bit of an advanced concept, but I felt it deserved a place in the presentation. I will not go into the calculations behind these two components as this is more of an introductory presentation. So, also known as diversifiable risk or systematic risk or market risk. So what this does is it influences the entire marketplace rather than just a particular sector or industry. Now, for anyone that's unaware, an industry refers to a much more specific group of companies or businesses, while the term sector really describes a larger segment of the economy. So as an example, we can think of something like the energy market. So the energy sector, which covers all of the industry, such as you can think of fossil fuels, the fossil fuel industry. We also have the gas industry. We also have the electrical power industry. Now, systematic risk is the unavoidable component of risk and hence cannot be diversified away. It is based on market conditions or factors such as, you can think of things like interest rates, inflation. Look at global inflation right now. And things like political uncertainty and natural disasters. Therefore, there is really no way to avoid systematic risk. But I do want to stress this, it can be magnified through leverage, okay? So a good example of systematic risk would be the COVID-19, right? The COVID-19 pandemic. This was an external risk that really impacted the global financial system. Throughout the lockdown period, we had government mandates placed in place, measures which forced businesses to close, and of course, small and large businesses. They were unable to operate normally, and this had a marked effect on the markets. So, as I said, systematic risk cannot be diversified, i.e., it cannot be eliminated by adding more assets to a portfolio. I will get to this very shortly because that covers the unsystematic risk side of things. Look, however, we can somewhat reduce systematic risk through efficient asset allocation. So, for example, let's say a portfolio of equities, bonds, real estate, and gold. Now, this together has a lower systematic risk than an all equity portfolio or an all bond portfolio. This is because certain systematic events affect different asset classes differently, of course. Bear with me. Okay, just checking the chat box there. All right, so now, although I said I wouldn't go into the calculation behind systematic risk, but for those interested, systematic risk can be measured through what's known as a beta coefficient. Now, beta is a measure of a stock's volatility in relation to the overall market. So when I say overall market, I'm talking about, say, the S&P 500 index. Now, let's assume the S&P 500 has a beta of 1. And individual stocks are ranked according to how much they deviate from that market's movement. So a higher beta coefficient means higher systematic risk, and vice versa. So a beta coefficient of 1 means that the investment has a systematic risk equal to the average systematic risk of the whole market being the S&P 500. Now, unsystematic risk or non-systematic risk, you'll see different definitions across the internet. So we have unsystematic risk, we have non-systematic risk, or we have diversifiable risk. Now, this is confined to a specific asset class or security, and it's essentially a function of the behavior of a particular asset. Now, in this case, portfolio diversification can help mitigate the non-systematic risks. And what this does is it reduces exposure and reliance on one specific asset class. This is the idea of having a portfolio. So unsystematic risk is also known as assets specific risk, meaning that the dangers that are unique to a single company, let's say, or an industry, are not present when you adopt more of a diversified portfolio. However, these risks do not only occur one firm at a time. So, for example, a poor manager in a company might pose a specific risk to a single company's stock price. But if poor management is the norm across a certain industry, the stocks of many firms in that industry might simultaneously suffer from risks associated with poor management. So other examples of diversifiable risk focus more on the microeconomic side of the table. And so think of systematic risk, the one we just discussed, as more of a macro-based picture. Look, examples of unsystematic risk can include things like changes in regulations that affect one industry, or an entry of a new competitor. So for anyone that studied Economics 101, this would generally cause, especially in perfect competition, this would generally cause a supply curve to shift to the right, meaning more quantity is produced at the same price level. Now, in perfect competition, it doesn't really resemble real world functions, to be quite honest with you, because they are price takers. They have to accept the price that they are provided. Look, other examples of course, a management risk, as I've said, and an employee strike. We're seeing a lot of strikes in the UK right now, and this is certainly an example of unsystematic risk. Now, here you can see an image, and this image really does a good job of explaining unsystematic risk. Now, as you can see, we have portfolio risk on the x-axis, and we have the number of assets in the portfolio on the y-axis for portfolio risk, and on the x-axis we have the number of assets in the portfolio. Now, portfolio risk, what I'm referring to here is the standard deviation, and the number of assets in the portfolio, of course, is the number of assets in one's portfolio. So a negatively sloping line reflects the relationship here between your portfolio risk and the number of assets in one's portfolio. So as assets are added to the portfolio through, bear in mind, correlation coefficients. So how do we find good assets to add to one's portfolio? Well, we have to look for assets that are either uncorrelated or negatively correlated with one another. So as some parts of the portfolio fall, others will rise or remain unmoved. So in investment, diversification really means allocating funds among various assets. So if one asset takes a loss, the money invested in the other assets may not be affected. Now, do bear in mind that investors are only really compensated for taking on systematic risk. As I've said, unsystematic risk can effectively be diversified away. So the more assets we add to one's portfolio, the less portfolio risk we will have. We have this small section here for the undiversifiable risk, which is, of course, the systematic risk. So as I said, we are compensated as investors or portfolio investors for the systematic risk that we take on. Okay, so look, common sense risk controls. I thought I would add this in here because I feel that many of us do forget these basic rules for risk management. Now, number one, look, guys, only risk what you can afford to lose. I know this is only risk what you can afford to lose. Pretty self-explanatory. If you require your money for rent, for bills, and things like that that are necessary to maintain your standard of living, you should not be risking that money. You should only risk money that you can afford to lose that will not affect your lifestyle. Look, guys, know your exit. Now, what I mean by this is before you enter a trade, before you click the entry, so I'm talking about traders, individual traders here who trade, say, the euro dollar long. You have to know your exit before your exit strategy before you press that entry button. This could be trading stops. This could be a fixed profit objective. You know, think of the AB equals CD, for example, the most simplest harmonic pattern in the harmonic pattern family, if you will. With that pattern, we have strict take profit objectives. So once the pattern completes at the D area or the PRZ, the potential reversal zone, we know if we take the Fibonacci retracement from A to D, we know 38.2% and the 61.8% are your take profit objectives, are your rules of engagement. Of course, you can hold for longer. I know some traders that do execute reduce risk to break even at 38.2% and then look to maybe trail the position at 61.8%. So it's very flexible in that sense, but you have to know your exit. I would highly encourage you to always know where you're going to exit the market or have some idea of the trading stop mechanism you will employ. Risk small amounts of equity, of account equity. Again, guys, this should be self-explanatory. If we have a $10,000 account and we're risking $5,000, you're risking 50% of your account. It will not take long for you to get that margin call. Risk small amounts of account equity. Risk what you're comfortable with, okay? Because the time you click that, you press that buy or sell button, you are, if you feel uncomfortable, you are generally risking too much, in my opinion. You have to build your risk slowly. So what do I mean by this? So for instance, if you're comfortable with $5 risk per trade, fine. Begin with that and then build your account slowly. Become more accustomed with the risk. So once you're accustomed with $5, move to $10, move to $20. As your account grows, let your risk become more familiar with the risk profile as your account grows. Do not just jump into a high risk profile as this will undoubtedly affect your decision-making process. Look, number 4, protective stop loss orders. I do hope we all employ these. You know, as its name implies, it's there to protect you. It's there to protect from downside, negative effects in your account, because we cannot tell, no one knows what's going to happen in the markets, trade by trade. We could have an event come out, an unscheduled event that will cause extreme volatility in the market, and it can really push your account to really unsustainable levels. And you may think you'll be quick to press the button, but I don't think you'll be as quick as what a protective stop loss order will be, because that will get you out at the best possible price it can, and it will be quick, especially if you're not at the screen. So I would always advise. Look, just because always advise using a protective stop loss order, and really just be consistent with your trading plan's rules of engagement. So that's everything from risk management to money management to your entry and exit rules. All right, so hedging. I'm sure we've all heard of hedging before. What does it mean when we say one hedges a position? So to hedge a position, it essentially means to offset potential risk of any adverse price movements. It is somewhat, dare I say this, it is somewhat of a sophisticated area of risk management. It's not as simple as placing your stop loss order, for example. Okay, so we have 3 points to get across here. So a direct hedge, this is first and foremost, and this is really the simplest. We can nowadays adopt what's known as direct hedging in the FX space. really this whole presentation is really geared towards the FX space anyway, because this is what I trade, this is what I'm familiar with. So this is really where it's geared towards this afternoon. So as I said, direct hedge is one of the most basic and one of the most simplest hedging strategies. So an example is if you're long the pound dollar of a specific size, a direct hedge simply involves taking the mirror opposite trade for the pound dollar. Now, the cost for this direct hedge is simply the commissions, right? As far as I'm aware, this is only possible when the broker adopts a hedging system, which allows as many open positions. Now, look, I know the majority of brokers now do operate with a hedging system, so I'm pretty sure most will. I know FP Markets does. And what this does is it allows as many open positions in different directions as you wish. So if the broker adopts a hedging system, then this allows for one position open in any direction in one instrument. All right, so the next one is diversification. We've really gone over this. It's basically not putting all your eggs, sorry guys, in one basket. So another well-known hedging strategy involves the options market, and it's the protective put. Now you can use strategies such as the protective put. So puts give you the right to sell your stock at a specified price for a specified time. So the specified price is known as the strike price. You can choose the price at which the put option sells. So that's again the strike price, providing you. What it does is it provides you with a secure floor for your stock's price. So if you're long Amazon, if you're trading the underlying markets, so you've bought Amazon shares and you want some protection, you can go ahead and buy a protective put. So buy a put and pay the premium. Now the premium is what the writer of that put, that's the seller, requires. So look, this is not free. The protective put, like the direct hedge, is not really free. You still have to pay a commission. But in the case of protective puts, you pay a premium. If your stock never drops to that price, so your strike price, you lose the premium. That's the price of your insurance. Now, the bottom line really is this: hedging a stock means buying an asset that will move in the opposite direction of that stock. So the hedge could be an option, a part of the futures market, or a short sale. All right, so leverage and margin. I really thought I needed to include this, as many are often confused by these concepts, especially in the CFD market. So leverage, margin, and position sizing in the CFD market is incredibly vital knowledge. If we cannot calculate our position size correctly, this could lead to all sorts of troublesome situations. So to kick off, let's understand that leverage and margin works together. Now, again, I am primarily discussing leverage in the FX space here. So, and as I've said, this is really what I've been involved in for the majority of my career. As I've said, leverage and margin are often misunderstood concepts, particularly, as I've said, in the derivatives market. It's important to understand that a relationship, as you can see here, a relationship exists between leverage and margin. They effectively cannot function without one another in the CFD market. So leverage is, as you can see here, this is incredibly important, this point here. Let me just see. So leverage is achieved using margin. Leverage is achieved using margin. More specifically, leverage is achieved through the initial margin. Now, I'm sure we've all heard of what initial margin is. So let's think about it this way. To trade a standard lot, now the broker requires a margin, an initial margin of $1,000 US. So therefore, you are able to trade 100,000 units of the base currency of that currency pair for 1,000 US dollars. That's your leverage. So this is where it comes back to. Leverage is achieved using margin. Okay, your leverage ratio is fixed. That does not change. So again, if we enter into a position, say we're entering into a standard lot, and your initial margin, and you'll see this soon, I'll show you a terminal. Your initial margin or your used margin is 1,000. You're effectively working with 100 to 1 leverage there at that point, because you're trading 100K position for 1,000 US dollars. Your initial margin, that is your leverage. So the initial margin crucially also provides you downside protection for both the broker and the trader or investor should adverse price movements unfold. Now, represented through a fixed ratio. So this is the leverage. This is what you'll see advertised on many brokerages' websites. Leverage is a fixed ratio, okay? Leverage could be 30 to 1, 100 to 1, or 500, or even 500 to 1. Now, again, this leverage ratio will not change. It does not change, but you can alter this through many brokers, their client portal. You can alter the leverage ratio, I believe. Now, leverage for the CFD market or the futures market or the options market is not a loan. I cannot tell you the amount of articles I've read saying that leverage is a loan. Think about this logically. How can that be a loan? Why would a broker lend you 100,000 US dollars for 1,000 US dollars? That's not, it makes no sense. They'd have to have billions to be lending out. It makes no sense if you think about that. So look, leverage in the derivatives market is not a loan. The brokerage is not lending you anything. Now, traders and investors can measure their effective leverage on each trade. And how this is done is quite simply dividing the notional exposure of a position by their account equity. So let's again take the example of the 100,000 unit position, so a standard lot, and we're trading that, and our account equity is say $20,000. So if we divide 100,000 units divided by the account equity of 20,000, that would give us a 5 to 1 leverage. So this informs us that we are trading with an exposure 5 times the account equity. So we can do that on every single trade. Now, how do we calculate? So really quickly, how do we calculate the margin percentage? How do we get that margin percentage? And we do require this to calculate our margin, our margin, of course. The leverage ratio, as I've said, is fixed by your broker. And the margin is a percentage rate. And we can find this through simple division of the leverage ratio. So let's take the leverage ratio of, say, the 100 to 1. Now, if we divide 1 by 100, that would give us, let me just bring up the calculator. So if I can find the calculator, just bear with me. All right, so let's divide this. So 1 divided by 100 will give us 0.01. That's 1%. Okay, 1%. So with that being said, 1 divided by 100, we've divided the leverage ratio, and that provides us our margin percentage, our initial margin percentage required to open a trade. Now, this percentage, that 1% there, if your account is fixed at 100 to 1, that's the percentage, the initial margin percentage that you'll have to work with. So as you can see, margin and leverage are very closely related. So we use the leverage ratio to obtain our margin percentage. Now, this is very important. So higher leverage equals to a lower initial margin. Lower leverage equals a higher initial margin. So if we have high leverage, If we have, say, 500 to 1, let's get the handy dandy calculator back out. So if we have a leverage of 500 to 1, let's work out our margin percentage, 1 divided by 500. Now that's 0.2%, okay? That's 0.2%. That's the margin rate. That's your initial margin rate that you'll have to effectively deposit as collateral into the trading account. That's very different to the 1% that we achieved through the 100 to 1 leverage. So higher leverage equals a lower initial margin, and lower leverage equals a higher initial margin. Do keep that in mind as you I think you do select this when you open an account. So really look, knowing the margin rate is 1% for a leverage of 100 to 1, we can calculate the initial margin, so our monetary amount required to trade. However, this will depend on the account's denomination, the currency pair traded, the leverage ratio, and the position size. So you'll need to work out the position size prior to calculating your margin percentage. Now, miscalculating one's position size, I've already mentioned this, can really lead to a higher initial margin requirement and ultimately a margin call, potentially a margin call. So the point I really want to get across here is not so much the leverage ratio that we should be focusing on, because I cannot tell you the amount of times people have asked me, what's the best leverage ratio? Although the leverage ratio tells you how much margin we need for the initial margin, it is largely the position size we need to focus on. As again, look, miscalculating the position size really can lead to a very difficult situation. And again, it leads to higher margin, and ultimately, depending on how much free margin we have left in the trading account, a margin call, or worse, we could hit the broker's stop out level, which is when the broker automatically begins closing your positions to bring you back up to margin. Okay, so margin calculation and position sizing. So I've got two examples here. One is for this is for let me just check this. This is for calculating your margin. So this is a very basic example. Account denominated in the same currency as the currency pair's quote currency. So as you can see here, the account currency is Aussie dollar. The currency pair is the Euro Aussie dollar. And the current exchange rate for this currency pair, this is not the same right now, of course. This is for the demonstration only. 1.56932 Aussie dollars. All right, so the position size for the margin calculation is 100,000 units of the base currency, and our leverage ratio is 100 to 1. Now, to calculate our margin rate, it's position size. So we know that's 100,000 multiplied by the exchange rate. That's 1.56932 multiplied by the margin percentage. Now, the margin percentage, again, guys, how did we work that out? 1 divided by 100, 0.01. Now, if we compute all of this, we'll end up with 1,569.32 Aussie dollars. So as you can see, 100,000 multiplied by the exchange rate. And then we multiply it's a product of these two values here. So we multiply that by 0.1. And that will give you your margin in monetary amounts. Now, if your account is denominated in the same currency as the currency pair's base currency, then all you need is the leverage ratio. You do not need any of this, and you can simply 1 divided by 100, it's 1%. So if you're trading 100,000 units, 1 divided by 100 is 1% of 100,000. It's 1,000 Aussie dollars. Do this on the calculator. Prove it to yourself, guys. But trust the formula. It does work. All right. So with the position size. This is where it gets interesting. And really, this is something we should all be focusing on. Of course, it's beyond the scope of this this webinar to go over all the position sizing formulas, but sorry guys. But as you can see, the account currency for this example is the same currency as the quote currency of the currency pair traded. So this is by far the most straightforward position size. If you want more information about this, we do have detailed videos in our trading academy that goes over all of this. So be sure to visit that. And we will have some links in the chat box at the end of the presentation, no problem. So as a very basic example, as I said, straightforward position size, all this really requires is dividing the trade risk. Trade risk is what? Trade risk is how much we are risking on our position by the stop distance. Now, quick point, stop distance, it has to be applied in terms of pips. So in the FX markets, 1 pip represents 0.0010 for most currency pairs. That's priced to the 5th decimal place. Now, for Japanese yen-based pairs, of course, that's to the 3rd decimal place, or second decimal place, if depending on what broker you are, because sometimes it's for the major FX currency pairs, euro, Aussie dollar, it's sometimes priced to 4 or 5 decimal places. For Japanese yen pairs, it's sometimes priced to 2 or 3. All right, so the example here, imagine I hate reading this out to you guys, but this is the only way I could really remember this example. So imagine a 10,000 UK trading account. This is your account size, guys. And the trader is willing to risk 2% account equity on each trade. So that's 200 UK pounds. That's your equity risk as of the current account balance. So the currency pair for this particular trade is the euro pound. Now, if we just stop there, euro pound, our account currency is denominated in the same currency as the quote currency of the currency pair traded. Our trading account is denominated in Great British pounds, and the currency pair we're trading is the euro pound. So the quote currency or the term currency is the GBP, and their account is GBP. So it is the same currency as the quote currency of the currency pair traded. Now, and the distance from the entry to the protective stop loss order is 30 pips. Now, 30 pips is 0.0030. You'll see, oh, there it is down there. Yeah, there we go. So recognizing that the account currency and term currency are identical, as I've just explained, no conversion with other currencies is necessary in this calculation. The reason is, if the trader, think about it like this, if the trader sells or buys £200 of the term currency, the trader simultaneously buys or sells the equivalent value of the base currency. So demonstrated below is the formula to determine the trade size for the featured setup. So again, divide trade risk. Remember, divide trade risk by stop distance for account currencies denominated as the same currency as the quote currency. £200 trade risk, we found that out there. That's our equity risk, divided by 0.0030. That's 30 pips, guys. That's our stop distance, and that will give us 66,666 units. Now, if your broker offers you a tab where you can put the units in, you could input this directly, 66666 units, 66,666 units, and that will keep your risk to £200. Or in MetaTrader, you can round it higher or round it lower. That's totally up to you. But we've rounded it higher here, 0.67 volume in MetaTrader platforms, and that's 7 mini lots rounded up. So you will be risking slightly more than £200 if you round it up, of course. For those interested in the margin calculation for this single trade, assume a 1% margin requirement. Assume we're trading with a leverage of 100 to 1, and the euro pound trades at 84.33. Remember, for the margin calculation, we do require when we're looking at accounts denominated in the same currency as the currency pairs, quote currency, we do require all of this information. Hence, we require the currency pairs quotation, which we have here, 0.8433, and we're trading 4 mini lots. Therefore equals, that shouldn't be 4 mini lots. Excuse me, guys, that shouldn't be 4 mini lots. That should be 7 mini lots. Equals 337.32. Let me just do that calculation because I want to be sure I'm giving you the correct information here. So to determine the margin for this trade, we are working with 100,000. No, it's not 100,000, is it? The position size is 70,000. 70,000 multiplied by 0.8433. Then we divide this, multiply this by the 0.01, and that will give us, so it's not even close. It really caught me out there. So this may be incorrect, but it's still the same it's still the same structure. The formula remains the same. I don't know why I've put that in there. I can only apologize. Trading 4 mini lots, therefore equals. Oh, that was an example. Excuse me. That was an example. This wasn't relating to this. So trading 4 mini lots, let's just redo that calculation. I apologize. So we are to calculate the margin for this trade. We would 40,000 because it's 4 mini lots. 40,000 multiplied by 0.8433. Then we multiply this by 0.01. And there we go, 337.32. Thank God for that. So that's the deposit margin required for that trade. We eventually got there. Oh, okay, so next up, margin call. This is where it gets really interesting. So while understanding the meaning behind a margin call is incredibly important, understanding the meaning behind the broker's stop out level is just as important. Now, if you trade with CTrader, they have something called a smart stop out. I won't go into details with this, but just be aware there is a difference. Knowledge, just bear this in mind. Knowledge is a form of risk management. If we lack knowledge in a certain area of our trading, this can really push our accounts in the wrong way, if that makes sense. So a margin call occurs when a trading account no longer has any free margin left. So this is zero. This will be when you would receive a margin call. All right. And that is the point at which equity, that's this value here. Let me get the pen up because I want you to see this. Just bear with me, guys. I'm not sure why this is not showing. I cannot get the pen right now. So this is where equity will be zero, will be the same level as margin. So you'll be 100%. So you'll see, I'm really messing this up. I apologize, guys. Let me start this again. So equity is equal to the margin level. So our equity level here is equal to our margin. So it could be 1,000 there. If our initial margin is 1,000, our equity will be also 1,000. This is when you'll receive a margin call. Right. Just to be clear, with FP markets, they do not physically call you. So you won't essentially receive a margin call, but you may receive an email. And what you'll see is this section here will turn red. So you'll certainly know something's not right. And this is essentially a request from the broker to bring the margin deposits up to the initial margin level. All right. So to keep existing positions open or liquidate a portion of your open positions, because at that point you have no free margin left. That will be zero. You cannot open any additional positions. Now, what's important, what's important to understand though, is the broker's stop out level. So if equity drops, so imagine this is $1,000 here, or $1,000. We've lost an incredible amount of money. This is $1,000. Our margin, our initial margin is 1,000. That will remain unchanged. And we start dipping lower. So we're now at 900. We're now at 800. So this will be 800. This will be 1,000. Free margin will remain at zero. That won't change until we start, our equity starts driving higher than margin. That's when our free margin will start changing. Now, if equity drops below 100% of this margin value here, as I said, 900, 800, this is where positions are in negative territory. And really, it's quite a dangerous position because with FP markets, what we do is we offer a 50% stop out level. So 50% of the equity at 1,000 would be 500. So we drop, our equity drops to 500. Let's say it drops to 500. This means FP markets would, or many brokers or all brokers would automatically begin closing the first most losing position based on the profit, okay, based on the actual monetary value. So just be aware of this. Just quickly, to calculate your free margin, it's simply equity minus your initial margin. That would give you your free margin. And to calculate your margin level percentage, that's equity divided by your initial margin, and that will give you your margin level. This will be 100%, guys, if you have a margin call. This will be 100% between these two values if these are the same. All right, so risk measures. I'm going to go over this pretty quickly, guys. So absolute, relative, and maximum drawdown. These are very important risk measures and something I do encourage all of you to really understand, especially if you're looking at assessing different potential strategies to invest in. So if you're looking at copy trading, you do need to understand what these are because these are very important. As we may experience a losing streak when we initially begin to trade. Now, the rule of thumb is to actually have, I think it's twice the amount of capital seen in your maximum drawdown result. So this could be from your back test, this could be from your forward test of a small account. So you should have at least twice the amount of capital compared to your maximum drawdown in your testing. For example, if our maximum historical drawdown in a particular market was $5,000 US, we can say that our strategy requires an account to begin with at least twice the drawdown value of $10,000 US. So on your MT4 report, you will notice three values: absolute, relative, and maximum drawdown. Now, excuse the very basic chart, but it will suffice for this demonstration. So the largest balance drop, but below so our initial deposit here is $5,000 US. So the largest balance drop below the initial deposit is referred to as your absolute drawdown. Now, as you can see, 5,000 to 4,000. So our absolute drawdown in this account is 5,000 minus 4,000. That's 1,000. Okay, that's your absolute drawdown in this case. The largest balance drop in percentage terms between 2 points is your relative drawdown. Now, the relative drawdown is from 6,000. It can be found from 6,000 to 4,000. This is your largest relative drawdown. So if we just quickly calculate this, just to prove, there we go. So to calculate a decline, we would say, so 6,000 minus 4,000 divided by 6,000. Oh, sorry guys, would give you, 33.3%. All right, so 33.3% rounded. So that would be your maximum relative drawdown. So 6,000 minus 4,000 divided by 6,000 would give you your maximum relative drawdown. It's not this area here. We can work that out if you like, but I can assure you this is not your maximum relative drawdown. Now, the largest drop in monetary terms is your maximum drawdown, the third and final one. That's your maximum drawdown, and that's 8,000 minus 5,500, which of course is 2,500. Just to prove that this is not your relative drawdown, we can do 8,000 minus 5,000. Whoops, 5,500 divided by 8,000. and that would give you 31 points. So 31%. So as you can see, that's not your maximum relative drawdown. All right, so I hope that really explains what to look for on your MT4 statements or MT5 statements. Now, crucially, higher drawdown. If you're looking at a system to assess, you're assessing a system's, profitability, the potential to invest in a possible system. Just remember that higher drawdown, if they work with a high drawdown, if they have a high drawdown in their historical performance, this means you have a higher chance of losing your total account. Of course, lower drawdown means lower chances of losing your account totally. Risk reward ratio. I'm sure we're all aware of what this is, but this is something I feel that we should just finish off with. So risk reward ratio equals the maximum risk price divided by the total profit target. So again, risk reward ratio, maximum risk price, it says it in the ratio, maximum risk price divided by the total profit target. So many claim that a minimum of a 0.5 risk reward ratio is needed on each trade to achieve success in the financial markets. Now, this means, so if you're risking, say, I do hope I've got my calculations correct here, just bear with me. Let's find the calculator again, just so I can prove it. Here we go. So if we're risking, our maximum risk price is say $100 and we're targeting say $200, that would give us a 0.5. So we're looking at double our risk. We're looking to double our risk. So that's why many claim that the minimum of 0.5 risk reward ratio is needed on each trade to achieve success. But look, I do know scalpers that work with a risk reward ratio of 1. So they essentially, but they have a higher winning percentage. But if we're working with a 0.5, this means on average, a trader wins twice the amount of risked capital, and really could only win, if you work this out, could only win 40% of the time and still generate a return over the long term. So look, here we go. Below 1, a trade possessing a greater potential reward over risk. A trade possessing a greater potential reward over risk. That's below 1. Yes, that's correct. Over 1, a trade possessing a greater risk over reward. So remember, a 1-to-1 is essentially the same. So we're risking 100 to make 100. I've just explained that here. 1 equals risk and reward. All right, so guys, thank you very much for sitting with me, bearing with me for 54 minutes. I do hope, look, to be clear, I've really only barely scratched the surface in terms of risk management here. But what I hope I have done is offered you something to think of in terms of we as traders and investors, we are risk managers first and foremost. And if you do not focus on your risk, it will eventually turn back and bite you, if you will. So look, in terms of upcoming events, for with FP Markets, our next event at 5 p.m. GMT is Advanced Fibonacci Strategies. This is going to be packed with Fibonacci expansions. I use this daily, and it's it's an incredibly high probability way of analyzing the markets, especially in the right location, guys. Also, look, again, if there are any specific topics you wish the team here to talk about, please do send in your comments and feedback to support@fpmarkets.com or alternatively marketanalyst@fpmarkets.com. Also, guys, as I say in every webinar, feel free to check out the FP Markets Trading Hub, packed with educational articles and analysis. We also have the Trading Academy. There will be links in the chat box. This really goes into detail regarding position size, margin calculations, support and resistance. It really covers everything that you need to begin with. Okay, let me just quickly run through to see if there are anything I've missed. There isn't. Okay, fantastic. So this is pretty much all I have time for today. Thanks once again for taking the time out of your busy day or evening, wherever you're based in the world. I hope you're able to walk away slightly more informed than when you joined. Once again, thank you so much, and I'll catch you on the next webinar. Good night.